Tax-saving investments are investments which help you pay less tax. They are also known as tax-efficient investments. There are many different types of tax-saving investments in India, and all of them have their own advantages and disadvantages. Investing in the right type of tax-saving investment is important because it can really help you save a lot on taxes. With so many different types of tax-saving investments available today, it can be difficult deciding which one is the best for you and your family. In this video, we will discuss the best types of tax-saving investments in India that you should know about. PPF or Public Provident Fund. The Public Provident Fund is a long-term investment option for Indian citizens. A public provident fund is an investment in a special savings scheme run by the Indian government. It is designed to provide a safe, low-risk investment vehicle for retirement savings. The PPF account provides tax benefits under Section 80C of the Income Tax Act 1961. The account can be opened with any bank or post office in India, and there are no restrictions on its use. The PPF account has an annual ceiling of Rs 1,50,000 for investments made by single person who are below 60 years of age. For senior citizens aged 60 or more, the ceiling is 2 lakhs rupees per annum. The amount invested in the PPF is exempt from income tax. However, when the account holder withdraws money from it, a 10% penalty is imposed on the withdrawn amount, and he or she will also be taxed on it. Public Provident Fund offers a higher rate of interest than the bank deposits. It is also one of the safest options for investments. Sukanya Samriddhi Account Scheme. The Sukanya Samriddhi Account Scheme is a scheme for the girl child, which was introduced in January 2008. The Sukanya Samriddhi Account Scheme aims to create a corpus of funds to meet the educational and marriage expenses of the girl child. The account can be opened in any bank, post office, or any other financial institution. It can be opened by parents, grandparents, or legal guardians of the girl child and can be operated by them as well. There is no upper limit on contribution to the account, and all contributions are eligible for tax deduction up to 1 lakh rupees under Section 80C of Income Tax Act 1961. The account can be operated by anyone, but is primarily for the girl child. It can be opened with a fixed deposit or with a recurring deposit. The primary aim of the account is not to earn profits but to accumulate wealth for later use. National Pension Scheme. NPS is a government-backed pension scheme in India. It was set up in 2003 with the aim of providing a secure retirement to all Indians, especially those living below the poverty line. The NPS offers tax benefits on investments made through it, and also offers higher returns than other investment schemes. Investments in the NPS are eligible for deduction under Section 80C of the Income Tax Act 1961. The National Pension Scheme provides an opportunity for tax savings and investments that are exempt from income tax. For residents who invest more than 1 lakh rupees per annum in the NPS, it is mandatory to file Form 15G or Form 15H with their annual income tax return. Investments made in other pension schemes are not eligible for any tax deductions. ELSS, Equity Linked Savings Scheme. Investing in ELSS can be a great way to save taxes. The amount invested can also be claimed as a deduction from the gross total income under Section 80CCF of the Income Tax Act 1961. The investment made in ELSS qualifies for a deduction from total income under Section 80C and also qualifies for a deduction from gross total income under Section 80CCF. ELSS investments are eligible for both deductions and hence provide more tax savings than other investments such as fixed deposits, Public Provident Fund, PPF, and National Savings Certificate. NSC. There are some restrictions on who can invest in ELSS, though you must be an Indian citizen or a resident of India. You must be 18 years old or older to qualify. You cannot have more than 10% of your total income coming from other sources, such as dividends, interest, etc. Systematic investment plans, SIP. A systematic investment plan, SIP, is a type of investment plan where investors make regular contributions over a fixed period of time into equity-linked savings schemes such as mutual funds, ETFs, or stocks. SIPs are typically used by investors who have access to funds at regular intervals and want to build up their investments gradually over time. The tax exemption for SIP is a great way to save money on taxes. It is also a good way to invest in your future. The tax exemption for SIP is available for investments made in equity, mutual funds, and debt instruments. The tax exemption for SIP is available only if the investment has been held for at least 12 months from the date of purchase. The maximum amount of investment that can be exempted from taxes under this scheme is 1 lakh rupees per year. The tax exemption for SIP is a great way to invest in your future. The conclusion of this video is that the tax-saving investments in India are not hard to find. There are many options to choose from. The most important thing is that each person has their own financial goals and needs. In order to make the best decision, one should consider all aspects such as risk tolerance, time horizon, income tax bracket, and liquidity needs. Tax-saving investments are an important part of your overall financial plan. You need to know what you are investing in and how it will help you save taxes.